Indian market has done better than US in rupee terms and only second to US in dollar terms in the entire world. So India has done phenomenally.
I hear people sometimes talk about how Bhagwan Che. I don't know what you make of it.
There are two types of analysts in the market. One is a technical analyst and the other is a fundamental analyst. So for a technical analyst, how Bhagwan Che. Yes, that is when you are investing in, you are a passive investor. You are investing in, let's say, a Nifty fund. But as a astute investor, let's say, your idea is to beat it. Not only beat, you have to beat even the actively managed mutual fund. The newer generation who are into a secure job, they are able to put money in SIP. And thankfully, India has been doing pretty well in the last 8-10 years in terms of stock market.
What is the level of exposure out of your total asset base that you should have as far as equity markets are concerned?
The exposure can be as little as 5% to maybe as much as 90%. That depends on each case separately. So one of my first basic tenet of investment is not to lose money on a permanent basis at the portfolio level. In the last 1 year, mid caps and small caps have really galloped. The Nifty has gone up 25%, but these have gone up 50%. So generally funds have done a wise thing because when something goes up so much, there's going to be, overvaluation.
Hello, everyone. These are exciting times for Indian stock markets, which are capturing global attention amid all that's going on internationally. And I'm sure investors today would be wondering, what are the new strategies that they should adopt? And investors who have still to enter the stock markets must be wondering, is this the right time to enter the markets? So who better to discuss this and many other topics around investments than Manish Gupta? Mr. Manish Gupta is a SEBI-Registered investment advisor with over 30 years of investment experience. So, Manish, welcome to the show.
Thank you, Sandeep. And I hope I am able to do half the justice of what you said about me. And great to have you on the show.
Thank you so much, Manish. So, before we get into details, would you like to give a bit of your background and experience?
Yeah, so I qualified as a chartered accountant in 1987. Thereafter, I did a corporate job for a couple of years. Then I started my own practice. And along with the practice, I started doing broker work, sub-brokership. Those were Harshad Mehta days, exciting days, lot of movement in the market. Then sub-brokership or brokership became my main business. And a few years later, I started mutual fund distribution. And along with that, I was investing on my own also. And that period helped me refine my strategies and, become a better investor.
So, Manish, that's a long experience in investment advisory and stockbroking. So what were your thoughts when you set up Equinox? And what are the kind of services that you intend providing to your investors?
In the early years, when I was a rookie investor, let's say, as every investor makes, I made a lot of mistakes, burnt my hands, lost a lot of money. But that tuition fee, it was expensive, but it came in handy. Number one was this. It also forced, emotional discipline into me. Two basic learnings at that time. Second, as a mutual fund distributor and a broker, I could see the results of the investor. So almost 99% of the direct equity guys, they were losing money. And almost 99% of the mutual fund guys, they created wealth. So that set me thinking that perhaps there is some fundamental difference between both people. So then I came across, the investing greats like Warren Buffett, Charlie Munger, or Peter Lynch. Back home, you had Mr. Damani, you had Rakesh Jhunjhunwala, you had Manish Chokhani. So I started following them. Then I realized that, okay, there is a method to this madness. So my own investing results started getting better. And consistently, I was, benchmarking myself against the indices as well as mutual funds. So my results were much higher than both of them. So after about 10, 12 years of personal investing, then I thought it's perhaps a logical step to, start advising. And I got myself registered as a advisor with SEBI.
So recently I was seeing this news clipping which seemed to suggest that there are only 1,000 odd investment advisors, or SEBI-registered investment advisors. And probably there are 12 crore investors, if I'm not mistaken.
That's right.
Why is it that, this proportion or ratio is so low? Is it that people have overconfidence in their abilities to manage these markets? Or is it that the requirements of SEBI are so onerous for RIAs that nobody steps into this?
Actually, it's a combo of both.
Uh-huh.
The requirements are very onerous,
Uh-huh.
and the intent of the regulator is, I think, very positive here. They don't want uh, bad apples to kind of get into this business, which is absolutely fine.
Mm-hmm.
But I think the investor is also responsible for this. Most of the investors are unaware about their own capability, right? They don't know what the investing results are. They haven't ever tabulated those results. It is a question of not knowing what they don't know. So I think it's a combo of both. That's why there is no demand. So that's why there are fewer RIAs. And that's how it's going on.
Yeah. And what do you think are the emerging trends in wealth management? And particularly, we see a lot of these technology leveraged platforms in wealth management. What is your take on these?
Look, I think fundamentals of wealth management remain the same. Practices keep on differing. Maybe 50 years from now, when there was no internet, people used to go to libraries, open books, read annual reports. Then internet came, and everything became on the tip of the finger. Now there is advent of AI, right? So it's being touted as the game changer, and perhaps it will be. But this information is going to be, democratic in the sense it's not going to be available in the hands of few. So it's going to become the baseline.
Okay.
So once it becomes the baseline, then where is the value addition coming from? Value addition will come from, the analyst or the investor's own experience, his second order, third order thinking skills, his, let's say, knowledge of the industry. So yes, it's a fantastic tool. It's going to change investing in a very fundamental way that now you have a team without actually having a team. A thing that used to take maybe days to compile is out in seconds. But that analysis has to be done by a human being, and I hope it stays that way. Otherwise, we are out of business.
So let's talk a little bit about Indian stock market specifically. How do you see their performance versus some of the global peers?
Actually, Indian market has done, I think, if I'm right, better than US in rupee terms, and only second to US in dollar terms in the entire world. So India has done phenomenally well. And just for example, China GDP has doubled gone up 7 times actually in last few years. But the stock market has not kept pace at all. It's maybe just double of what it was.
Okay.
So India has done phenomenally well.
And obviously, when you see these kind of returns, there is also the associated volatility, turbulence. What is your advice or what is your take on this volatility? What should investors do under these circumstances?
Actually, there's a fundamental difference between volatility and permanent loss. Now, if there is an investment which goes 2 steps ahead and comes back 1 step, you are still moving 1 step ahead, right? So this is what volatility is. Investors should not be afraid of volatility, but he should definitely be afraid of permanent loss. So this has to be distinguished. So that is the education that the investor needs to have. That these two are fundamentally different.
And in general terms, how would you correlate, for example, a country's GDP growth with, stock market returns, let's say?
Okay, let's little bit of macroeconomics in a very simple way. Let's assume that there is this country where there's only one manufacturer of pencils, let's say. So the GDP of that country will be calculated in the number of pencils that producer produces. So let's assume in a base year, in a starting year, that manufacturer is producing 100 pencils, which he sells for 1 rupee each. Now the GDP of that country for that year would be 100 rupees. Next year, he produces 107 pencils. So 7% is the actual real GDP growth. Right? And now he decides, okay, I'm going to increase the prices by 5%. So his top line now becomes 112. So this 5% inflation plus 7% real growth, this is called nominal GDP growth. So this becomes 12% nominal GDP. Now, replace this pencil manufacturer with India. These are exactly the same data at which India is growing. 7% GDP real growth and 5% nominal inflation growth. Now, coming back to that pencil manufacturer. So last year, his turnover was 100. This year, it's 112. If the profit margin is same, that means his profits have grown by 12%. Stock prices move in tandem with profits, right? So if profits have gone up 12%, stock prices will move up 12%. So this is what average investor in India should expect from investments, that he's going to get long-term returns of 12%, though it is not going to be linear. It is going to be, that same story, 2 steps back front and 1 step back.
Okay. And if we look at in more recent times, let's say last year, I think 2024 Diwali versus last year Diwali, I think markets have grown by about 25%, if I'm not mistaken. Would you consider them overpriced at this stage? And if yes or no, whatever your answer is, what would you suggest should be the future course of action or future expectation of returns?
Okay. Having established that a normal range of return that you should expect in a country like India is about, let's say, 12 to 14%, right?
Nominal basis.
Now, in last 1 year, Diwali to Diwali, somewhat 2080, we got about 25% odd returns on Nifty, and then small caps were much higher, maybe 35% or whatever. So this is definitely kind of an overreach, right? So the stagnation, sideways movement, or the correction that we are witnessing right now is the normalization of the excess returns that we have got in the last year. But mind you, in the last 5 years or 3 years, the CAGR, compounded return, is not more than 14-15%.
Okay.
So we haven't really gone into that bubble territory. We are not highly overvalued. We are slightly overvalued. And I think my estimate is, or what I'm working on, is that maybe by next year, we should come back to a growth stage. This excess will be taken away.
So if I understand you correctly, what you're saying is that on a constant basis, about 13, 14, 15%, that's the kind of stable returns the market should kind of, at least in the medium term, on a per year basis, get. Yep. And there could be some ups and downs, but over a period of time, that's the kind of annual returns.
Yes, that is when you are investing in, you're a passive investor.
Okay.
You are investing in, let's say, a Nifty fund.
Yeah.
But as a astute investor, let's say, your idea is to beat it.
To beat the
Not only beat it, you have to beat even the actively managed mutual funds. Otherwise, why would you do so much of work?
True.
You just put your money in a mutual fund and sit back and relax. So the idea is to beat mutual funds by a decent margin that compensates for the effort, for the risk that you take, your time that you spend on it. And one more point regarding the GDP issue. There's a very interesting pivot taking place in India. It is the per capita GDP which matters, right? So studies have shown that when a country's per capita GDP is $2,500 per annum, there is very little disposable income in the hands of a householder to spend on, discretionary items.
Yeah.
Most of it goes towards food, rent, daily necessities. The moment you cross 2,500, you have money in your hands. Now, when you have more money, you're not going to brush 10 times a day, but you will want 10 shirts, right? So the recent, things you are seeing, like watchmakers are making a lot of traction in sales, or luxury cars or luxury apartments. So now India's GDP is touching $3,000. So this entire discretionary space is witnessing that benefits of that overflow coming.
Yeah, that should obviously, give a great domino effect to the industry and to the stock market.
Yeah, definitely.
And probably also, I think a lot of these investors will have surplus money also to put into the stock market.
Definitely,
so it's the consumption story, but it's also the investment story.
Definitely. And it both play on each other.
Yes, exactly. Yeah. And so among all this, which are the sectors which you think could be the growth drivers going forward for Indian stock markets?
Okay. So Indian GDP currently 60% of it comes from consumption, right? And as we just discussed about discretionary spending, so a bulk of, let's say, high growth is going to happen in discretionary space. The staple space is kind of saturated in the sense that, okay, 5%, 7%, that's all it's going to be. But the discretionary space is going to explode. So even recently, you must have seen that Coldplay concert or Diljit Dosanjh.
Correct.
I mean, people looking for experiences. They have that wherewithal to spend on, right? Then, so far, India has been a service exporter. We've done tremendously well in software. But with this PLI, Make in India, Atmanirbhar, and stuff like that, you've seen what has happened to mobile manufacturing in India.
Even defense to that extent.
Defense to that. So manufacturing as a theme should do well. And also with, we'll come to it later with Trump coming in. So maybe India is at an advantage in terms of exports, though the world is getting nationalist, but still comparatively we might be better off. Then as you mentioned, defense, this focus on defense indigenization is a big theme for India. And then one more theme is that financialization of savings that we said. People have more surplus. And as you have seen, domestic inflows have been so strong. So that money is coming into it. And the service providers for, the enablers like mutual funds, the RTAs, brokers, they're all doing tremendously well. And they should keep doing well for a long time to come.
So a lot of financial pundits say that, for any investor, you have to have exposure to equity, and that is really a key thing. So I presume since you are in the markets, you also hold the same view. My question to you is a little bit different, which is, what is the level of exposure out of your total asset base that you should have as far as equity markets are concerned?
This is a very subjective thing, right? So my take on this is that, one, everybody should have exposure. And the exposure can be as little as 5% to maybe as much as 90%. That depends on each case separately. But even people who have not done any investment in stock markets, they should. The starting point should be money that you don't need in the next 5 to 7 years. That is one. Second is money that doesn't give you sleepless nights. Wherever that, that pie converges, that is the amount you should put. And slowly, as you get more comfortable, then you can increase your allocation. But this should be the starting point.
So given what you have said, there's also, I would think that there is more excitement about the stock markets. And because of that, the investment options that you pursued in terms of asset classes has also undergone a change. I remember, 10 years ago, a lot of us were investing in real estate big time, and it's probably gone a bit out of flavor. What do you think, when you talk to investors and people, your clients?
Well, I think most households in India are still heavy on real estate.
Okay.
Though it has diluted a bit, but they are still heavy on real estate. They can afford to shift a bit more towards equity. And that trend has already started. I mean, we are getting a SIP book of about 20,000 crores per month. So the newer generation who are into a secure job, they are able to put money in SIP. And thankfully, India has been doing pretty well in the last 8-10 years in terms of stock market. I mean, we have not had a major drawdown. We have not had a major crash. So they have got the confidence. So that, augurs very well. It's building a base. So I think more and more people will join in slowly. And this is going to become a very big trend in India.
So Manish, if I was to approach you as an investor, obviously the question I would have in mind is that how is Manish or Equinox going to help me with wealth creation?
Okay.
So what are going to be your strategies that you would adopt to deploy, to manage, let's say, my corpus or any investor's corpus? And how are those portfolio strategies going to be different for different clients?
Okay. So one of my first basic tenet of investment is not to lose money on a permanent basis at the portfolio level, not on individual stock level, but on the portfolio level. So there should not be permanent loss of money, right? Volatility can be there, but no permanent loss of money. So how do you ensure that? You ensure that by having the core of your portfolio in companies which are extremely, extremely strong, leaders in their own field, with extremely good managements, with a large market, great visibility of future growth, right? At a reasonable price. Now that is first tenet. Second is that I prefer to invest only in those areas where I know those areas very well. I don't go into areas that I don't know of. I mean, for example, let's say it's today, if you ask me about investing in an AI company, I would have no idea where to put money. And frankly, I'm very happy being late in a party because by that time, the music has sobered down, You can see who are the winners and who are the losers. The failures have already bitten the dust. The ones who are surviving, they are available at much better valuation. So it's always better in the market to arrive a little late. And to take a cricket analogy, I mean, you keep taking singles, and once in a while you will get a loose ball, you can loft it over the park. So not to lose money, invest in what you know. And third is invest only that much that balances your financial needs along with your risk-taking capability, your, that that stress level capability.
So Manish, that brings me to kind of a little bit thinking around the asset classes. So, if you were to manage a portfolio for somebody, what are the typical asset classes that you would probably suggest to the person, whether managed by you or not managed by you, to kind of, how to divide their investable surplus?
With, opening up of financial instruments, there's a lot of options available. So real estate has to be in a portfolio, right? I mean, it is heavy. We are not saying that it should not be there. It has to be, number one. Stocks have to be a part of your portfolio. Percentage will differ from person to person. Debt has to be a part of your portfolio.
Okay.
Again, it will also depend on your needs and requirements. Then gold also should be there.
Okay.
Maybe 5%, maybe 10%, but gold also has to be there. Then now we are getting these interesting instruments called REITs and InvITs. Now, REIT, just in simple lay term, is like it's the commercial building which somebody owns. He's given it out on rent. When you buy a REIT, the 90% of the rent that he receives, it is called NDCF. So there's a calculation involved to it, but mota moti, 90% of the rent is paid out to the investor on a quarterly basis. So that is a very interesting thing because you can buy for as little as 5,000 rupees, you can buy it for 5 lakhs, you can buy it for 5 crores. It's listed in the market. It's liquid. Same goes for InvITs. So all these should be part of your portfolio. And they all act as, counterbalances. If one thing is going down, something else is supporting it. So it's kind of a, nice combo, a nice buffet for you.
And let me come back to the equity side of things. You also mentioned earlier in the discussions that while the Nifty has gone up by about 25%, the small caps, mid caps have probably gone up. And I was also reading that some of the funds have also stopped taking, new investments in small caps, etc. I think there was also something mentioned by SEBI about a little bit of, concern around small caps.
That's right.
What do you feel about these?
Look, in last 1 year, mid caps and small caps have really galloped, right? And broader, I mean, the Nifty has gone up 25%, but these have gone up 50 or 40%. So generally, funds have done a wise thing because when something goes up so much, there's going to be, overvaluation there. Having said that, there is a cap to which a Unilever or a Nestle can grow, right? They already dominate the market, right? So rapid growth is going to come only from below the top tier. So you have to be choosy in selecting. So small caps and mid caps are definitely going to grow faster than the large caps, but they are also going to be much more volatile. And there can be permanent loss of capital also if you're not careful in picking stocks. So the idea of SEBI and idea of mutual funds to stop or caution people is absolutely well intentioned.
But at the same time, it's also important to pick the right kind of small cap, mid caps to have them in your portfolio for the growth opportunity that you spoke about.
Definitely.
Yeah. Okay. So we spoke a little bit about diversification in terms of asset classes in the portfolio. How about balancing the short term versus long term? I think that's also an important aspect which investors look at.
Look, even if you are a James Bond in terms of risk taking capacity, and if you come to me to manage my portfolio, I will never put you 100% in equity. So there's always going to be some debt, some gold, some maybe REIT if you want, if you like. It is not compulsion, but debt has to be there. So once debt is there in a portfolio and looking at your future needs, then that acts as a buffer for your short-term needs and other stuff.
Because it doesn't see so much up and down.
No, debt will not see. I mean, debt also we put in different baskets, right? So short-term debt will absolutely not change along with the interest rates. Long-term debt will swing because it's inversely correlated to the interest rates.
Correct.
So debt also will put in different brackets.
Okay.
And we will have a healthy portion of debt in your portfolio.
So that brings me to the age-old question: is equity investing a science or an art?
Look, as far as reading balance sheets, some arithmetic is involved. Ratios are involved. To that extent, of course, it's a science. But a company, its competitive moats, addressable market size, its business strategy, its product quality, international trends, threat of alternate products, stuff like that. That is not science, that is art. And second order thinking, third order thinking, that is not science. So I think that a 12th pass can handle the science part of it very easily. There's not much to it. But the art part of it takes time. You have to have the aptitude and you have to have spent that time, made those mistakes. The emotional angle to it, the fear and greed, you have to learn to handle those two conflicting emotions and be able to take a decision which is, objective, which is based on reality rather than your emotions.
Yeah. So Manish, a follow-up, I'm sure there would be clients who would be, various kinds of clients who are a little bit more patient and clients who are a bit more greedy, and loosely using that word of greed here. So how do you handle those kind of clients?
Well, being an investment advisor is a little similar to being a counselor, right? There are times when market goes down and client gets panicky. So you have to hold their hands and actually make them look at their finances. Okay, do you need this money? Or are you only pulling it out because you feel the market is going to tank further, right? So when an investor talks to somebody outside of his circle, to talk to an advisor, he starts to see things a little bit differently. Similarly, on the greed side, it's a little more difficult. Greed is a little more difficult to handle because as advisors, we know that market is not going to remain down for a very long time, so fear is easily handleable. But in greed, you don't know, market can fall also, So the advice we give to them is that, okay, if you feel that you want to take some money off, then instead of taking 50% off from the portfolio, give it a go, take out 5%. Then we'll think about another 5% a month later. So stagger it a bit. So once he takes out a small portion, he feels a little sated, he's a little less greedy now. And if the market goes up further, then he realizes, okay, man, if I had sold everything at that time, it would have been a bad thing to do. So It's more of a hand holding and stuff like that.
But sometimes it could also be the extreme angle of that greed, right? Where people want to double down on their good bets. And I'm sure there would be equal number of those investors as well.
Definitely.
What about them?
Asset allocation, two things to it. One is broad asset allocation between equity and debt.
Yeah.
Then within the equity component, there is asset allocation in each investment, right? So we kind of try to make sure that a single bet does not cross 10 to 15% of your portfolio.
Okay. So
because it becomes risky. So if a position is doing very well, then it's already, reached a sizable percentage of a portfolio. If it's doubled, then the initial allocation was 5%, now it's 10%. So then we tell them that, okay, man, this is the outer limit. Beyond that, it's not going to be, it's a huge risk. Yeah. Hopefully they agree to it.
So, yeah, I hear people sometimes talk about Bhav Bhagwan Che, and I don't know what you make of it. Is it a myth? Is it something you believe in?
There are two types of analysts in the market.
Yeah.
So one is a technical analyst and the other is a fundamental analyst. So for a technical analyst, Bhagwan Che,
true.
He just looks at the price, the momentum, and the volume. That is his only guide. And you can skin a cat in many ways, and many people skin it like this. But just to add to it, I mean, with no disrespect to this side of analysis, I haven't seen too many billionaires who are technical analysts. All the billions that you see are fundamental analysts. So the other approach, which is fundamental analyst, for him, price is, he's opposite of technical guy. Technical guy will buy when it is rising. A fundamental analyst will be happy when it falls because he feels I can buy it more. And when a stock rises, he'll be happy that, okay, I can sell at a better price. Having said that, price always conveys something. It is always conveying something. And as human beings, our information, our analysis, our judgment, it is limited. So a wise and experienced investor will always make space in his analysis for contradictory, let's say, information coming from the price movement. So if you like a stock very much, but the entire market is going up and it is falling down, you have to take cognizance of that. So for a fundamental analyst who's been around for a while, he knows that price also means something, though it is not Bhagwan, but it's one of the inputs he has to consider.
Okay. So it's often said equity markets are kind of, equivalent to the journey of life in some ways. What's your take on it?
Okay. It's very similar in many ways. So I'll just cite out a few of them. The first is that the correlation between the right process and good results in life as well as in equity markets is not 100%. It is 70% or 80%.
Yeah, sometimes you put in a lot of effort, you don't get the results. So.
I mean, everybody knows exercise is good for health. You should exercise. But exercising regularly does not mean that you will not fall in, right? You can. Similarly, if you follow the right process in stock market, not necessarily that you will come out tops. Yeah, you could have a loss. I mean, something bad can happen. But that does not take away from the criticality of the right process, because the reverse of it is only 30% chance.
Yeah.
If you do a bad process, then your chance is 30%. So it's always, better to be mostly right than be absolutely wrong. So
true.
That is one. Second is that in life and in stock markets, patience and hard work, they are required. I mean, in life, whether education, whether your job, whether your family, your relationships, they need nurturing, they need time. Similarly in stock markets, you have to, it is not twice a year crop. It is a tree. I mean, you plant it and you wait for it to grow, and then it will give you fruits. So this is a second similarity.
Yeah. And probably that's one of the reasons one needs an investment advisor, because you can put in your time
Yes.
in that effort. So,
Yes. And third is that it is also a very humbling experience. Right? So, and it also teaches you whom to listen to. For example, there are many people who will say that market to operator se chalti hai. Market is all insider trading. Market to kismat se hai. And in life also you'll hear people say that man is helpless. He can't do anything. I mean, life can be shit and you can't handle stuff like that. But if you look at great investors who tell you a way of doing it, and their track record for 70, 80 years is great. So you know that, okay, this is the guy I want to believe in, because not only is he saying something, he's done that, he's demonstrated that. Similarly, in life, I mean, if you look at those Stoics, they say that, okay, you can handle everything in life. I mean, you have it within you. So now, as a human being, you make a choice whom to believe. So it's a humbling experience. You surrender your ignorance. So that's a commonality. And there's another big dissimilarity. You know, in stocks we say that you should not be emotionally attached to your stocks. You should switch if something better comes along. Sandeep, I would advise everybody and you, in life it doesn't work that way. You're not supposed to. If somebody better comes along, you're not supposed to ditch the It's not going to be healthy.
Okay. Interesting. Yeah. So you spoke a little bit about US elections and Trump earlier, and I still want to give your specific thoughts. How do you think these developments are likely to impact the stock markets?
Actually, it's a very developing story. Trump has not yet laid down what he's going to do. But from his last 4-year regime, one thing is very clear, that he is very anti-China. He's anti-India too in terms of tariff. And he said India is a tariff king. But he's more anti-China. So let's say he puts 50% tariff on China and 20% on us. So we are gainers to that extent. So I feel that it's going to be positive. But it will take some time. There are going to be turbulences on the way. Some industries are going to suffer badly. Some will do very well. So let's see how it unfolds. But on the whole, it's going to be better for India.
So Manish, it is often said that selling is more difficult than buying. How do you decide which is the right moment to sell?
Yes, Sandeep, very correctly, selling is much more difficult than buying. And after many hits and trials, I have made an acronym for myself, remember myself. The acronym goes by the name BEAST, which also kind of describes the market itself. So the B stands for bubble valuations. And by bubble valuations, I mean that, let's say, the broad market, the entire market, has given 30% compounded in last 5 years, or 50% compounded in last 3 years, or 25% compounded in last 7 years. When the average return you were to get was 12 to 15%, then it means that the entire market is in a bubble stage. So that is one time you should be pairing at least some percentage of your equity investment. E stands for euphoria in a particular stock. So sometimes what happens is, a story goes on about a particular industry or a particular stock, and that stock goes to stratosphere. Now, when it goes to that space and you try to justify its valuation, even by assigning it, ridiculous growth rates, ridiculous P ratios, even then it is not justified. You just can't justify that valuation. So that is the time you should be selling off. A stands for asset allocation. Asset allocation is, let's say, your comfort for equity is 40%. And the market rises so much that your equity now becomes 60%. Now, this is the time You don't have to look कि कल क्या होगा, market और बढ़ेगी, घटेगी. No, you have to reduce your asset allocation to equity and bring it down to your comfort level. S stands for something better. So if you have a stock and it's a good stock, but a better stock comes along. Now your money is limited. I mean, there's only that much you have. So you have to, let go of emotional attachment to that stock and buy the other one. And last is trigger loss. So we would be buying a stock or an industry based on a certain trigger. For example, let's say government imposes anti-dumping duty on steel, let's say. Now suddenly steel in India becomes, steel industry becomes profitable. And you buy a steel industry. Tomorrow government takes away that anti-dumping duty. So the entire premise on which you entered that stock has gone. So when the trigger goes away, you sell. So these are the 5 major parameters on which I base my selling decisions.
Interesting. Beast is what to remember.
Beast.
Okay. So I'm sure, Manish, there are so many clients you have who come to you for investment advice or whom you advise them on their portfolios, etc. Any interesting story that you would obviously, keeping it confidential, any interesting story you would like to share about a client?
This is actually about before I became an advisor.
Okay.
So I told you I saw that mutual funds investor made a lot of money, more than direct equity. And I read all those great investors' investment theses and stuff like that. And I theoretically understood that this is possible. But there was no, down-to-earth example in front of me. These guys were on TV. I mean, I didn't know them. There was this client of mine. And he was making 10 baggers, 20 baggers, 30 baggers in front of my eyes. So I saw he was investing with me 5 years ago, and today his net worth was maybe 30x of what it was 5 years ago. And he was doing exactly the same thing that I was reading about. So that really, gave me that optimism or that confidence that, okay, it's not just theoretical, it can actually be done by a grassroots guy. So that's what prompted me to do myself on my own investments and then eventually become an advisor.
So as we draw towards the close of this discussion, one last question that I have for you is that if there's one single investment advice you were to give, what would that advice be?
Single advice if I have to give would be to an investor is to know thyself. And this includes, 3 components. One is know your finances. How much you have at present? What are your cash flows going to be in future? What are your goals? What are your expenses? So that's hard facts, right? Number 2 is you should know what is your risk appetite. So you should ask yourself, how will I feel if the market falls by 30-40%? It's going to fall. In your investment journey, it's going to fall every 3-4 years, every 2-3 years, it's going to fall that much. So you have to know your risk appetite. And third thing you have to ask yourself is, am I capable enough to handle my own money? And that you can do by, if you've already been investing, you can see your returns and benchmark it with the indices and the mutual funds. So these 3 questions you ask yourself, and they will, give you a very clear answer whether you need an advisor or not. If you're doing very well, there is no point of going for an advisor. But if you are not, then it's imperative that for your financial health to go for an advisor.
So thank you, Manish. Thank you so much for being on the show. It's been a pleasure.
Thank you, Sandeep. Thank you for having me on the show.
Thank you.
Thank you very much.
So I hope you found the discussion interesting, and it's a good moment for you to self-reflect and do a bit of analysis for yourself. How have you been doing on your investment strategies? Do share this video for people who you think would find value in this, and please leave us your comments. Thank you.
Hello, viewers. I know first step into a swimming pool is tough, and getting into equity is equally tough. What I would suggest is that Just take that small step, whether through mutual funds or through direct equity. If you need help, take help of an investment advisor. Not taking any equity exposure is a risk in itself because your money is getting eaten away by inflation. You have to beat inflation. So go ahead and take a plunge to the extent that you're comfortable with. And I'm sure you will feel good about it down the road.